Music fades in, low and tense. You're not imagining it. The housing market just flashed the same warning signal we saw before the 2008 crisis, only this time the data points to something potentially worse. Home prices have never been higher on an inflation-adjusted basis. The Case Shiller index just hit 299.9, 12% above the 2006 bubble peak of 266.4. The median U.S. home price, $413,500 as of August 2025, a 60% jump in 6 years. And affordability, it's broken. The typical household needs to spend 44.6% of their income to afford that median home, well beyond the 30% threshold experts consider sustainable. Nearly 75% of U.S. households can't afford a median-priced new home. The minimum income required, $141,366. As one analyst put it, even a 0% mortgage wouldn't fix affordability in many markets. Price-to-income ratios are pushing 5 times median household income. That's a distortion signal, not a healthy market. Mortgage rates aren't saving the day either. 30-year loans hover between 6.09 and 6.37% as of October 2025. The average monthly payment for recent buyers has surged to $2,225, the highest since at least 2008, and recent movers are paying $648 more per month than those who bought 5 years ago. That's a 41.1% jump, the biggest payment gap since the last crisis. This shock is locking people in. Homeowners who refinanced at 2 to 3% in 2020 and 2021 can't afford to move, constraining supply and distorting the entire system. Now look at supply. New home inventory reached 490,000 in August 2025, the highest since 2007. Months of supply dropped from 9 to 7.4 between July and August, but that's still elevated compared to normal. Housing starts are down 6% year over year. Permits are down 11.1% from August 2024. Builders are pulling back. Unsold completed homes hit 82,000 in May 2025, the most since July 2009. Builder sentiment sits at 37 in October. Below 50 means pessimism. This isn't caution, it's retreat. Foreclosures are rising too. Q3 2025 saw 101,513 properties with filings, up 17% year over year. Foreclosure starts increased 16% with 72,317 properties entering foreclosure. Bank repossessions, up 33% year over year. That's 6 straight months of annual increases through August 2025. Combine that with rising credit card delinquencies at 3.5% and student loans at 20%, up from 2.8% and 17% in 2022. And you're seeing the early stage of broader financial stress. Regionally, the cracks are widening. Phoenix is down 15.1% year over year with inventory up 114%. Cape Coral, Florida, is seeing 17-24% price declines in some neighborhoods with inventory tripling. Austin's correcting hard. Florida statewide is down 3.1% with 182,000 plus active listings. Arizona leads with 36.8% of homes seeing price cuts. Colorado, Nevada, Utah, price-to-income ratios above 5, reduction spreading. Compared to 2008, the similarities are undeniable. Elevated debt-to-income ratios at 40.5%, FHA at 45.1%, approaching the 43% levels we saw back then. The difference? We don't have subprime contagion in the same way. What we do have is a market where prices have detached from incomes more than in 2006. The inflation-adjusted Case Shiller at 299.9 is 67% above long-term norms, the biggest housing bubble in U.S. history by that measure, and home builders are blinking. In October 2025, 38% cut prices, averaging 6% reductions. Major players are canceling future supply. KB Home reportedly canceled 9,700 lots. New construction is down 11.7% with permits off 12%. When builders slam the brakes, it sets up a supply shock later, but only after near-term price pressure from incentives and inventory resets. Corporate America is signaling the same story. Horton's net sales orders fell 15% in Q2 2025 to 22,437 homes. Order values dropped 17% to $8.4 billion. By Q3, net income fell 24%. Lennar's EPS dropped from $3.45 to $1.81 in Q2, down 48%, as they relied on incentives and negative cash flow to move product. Home Depot's same-store sales flipped negative again in Q1 2025. Q2 traffic fell 4.2%, and big-ticket purchases are down. When homeowners stop spending on their homes, confidence is cracking. Insurers are pulling back too. State Farm halted new homeowner policies in California. Farmers withdrew from Florida. Multiple carriers are refusing to underwrite in overvalued or high-risk areas. These aren't random decisions. They're risk models flashing red. The market is seizing in odd ways. Nearly 15% of home purchase contracts fell through in June 2025, the highest since tracking began in 2017. Days on market rose to 28 from 24. Total inventory climbed to 1.55 million units by September 2025, still below 2008, but rising fast as buyers pull back. Forecasts now assume a soft landing. Zillow sees a 1.7% decline from March 2025 to March 2026. Others call for 0.54% growth in 2026, but those projections assume economic stability, an assumption these warning signs are calling into question. Even with 2 Fed cuts in 2025, mortgage rates are still likely to live in the 6-7% band, maybe 5.9% by late 2026, if nothing breaks. If you're buying, understand this. Normal rules don't apply. Affordability stress at this level historically precedes major corrections. If you're in Phoenix, parts of Florida, or Austin, you're already seeing phase 1. If you're investing, patience matters. Builder retreat, rising foreclosures, and affordability ceilings point to a reset with selective opportunities, while speculative plays carry real risk. If you're a homeowner, the rate lock effect gives some protection, but local outcomes will diverge sharply from national averages. Watch your micro market. Now zoom into Texas, real estate's giant of the South, where the recalibration is on full display in 2025. Statewide, median prices are down about 3.2% year over year, now around $331,000, over $70,000 below the U.S. median. Austin leads the declines at 6.4%. Dallas is at 4.1%. San Antonio, 3.5%. Houston, 2.8%. Inventory is up 30.7%, with more than 132,000 active listings. And closings now take about 105 days, longer, slower, more negotiated. 3 years ago, Texas was a rocket ship. Low taxes, cheap land, massive in-migration, Tesla and Oracle planting flags. Listings vanished overnight, and prices spiked. By 2024, supply doubled, and sellers lost control. With 30-year rates hovering 6.87%, affordability became the hard ceiling. Demand cooled. Psychology flipped. In 2021, buyers feared missing out. In 2025, they fear overpaying. Bidding wars are gone. In their place, seller paid closing costs, rate buydowns, incentive. Experts don't call it a crash. Texas didn't overbuild like in 2008, and population growth remains strong. This is a repricing of risk, a normalization. Affordability is the choke point. At 3% in 2021, a $330,000 home cost roughly $1,400 a month. At 7% in 2025, it's north of $2,600, before taxes and insurance. Middle-class buyers are getting priced out. Sellers either cut or wait. Inventory rises, but statewide sales are down just 1.5%, because deals still happen, just at a crawl. Insurance is the sleeper issue. Premiums are up 20-40% across the state, especially in Houston and along the Gulf as carriers price in storm and wildfire risks. That adds $200, $300 a month for many buyers, erasing affordability gains. Lenders demand larger escrows. Closings drag past 100 days. Insurers are shrinking coverage in flood-prone zones, and FEMA map tweaks can freeze entire neighborhoods overnight. Liquidity is thinning. More listings, longer timelines, more cancellations. One Fed hint about delayed rate cuts can stall deals statewide within hours. Coastal insurance, moratoriums after storm warnings do the same. These micro freezes stop the market for days, creating herky-jerky momentum. Buyers now watch rate moves like weather reports. As one realtor put it, "We're not waiting for prices to drop, we're waiting for rates to breathe." Texas's growth model is feeling strained. No income tax attracts people, but it limits funding for infrastructure and housing programs. Zoning backlogs, staffing shortages, and higher construction costs slow everything. Developers in Austin and Dallas face doubled permit times. Houston layers flood regs and inspection bottlenecks. The result, a slow, uneven pipeline that reinforces the pause. This isn't one market, it's several. Austin took the hardest hit, down 6.4%, with tech layoffs and luxury overbuilds weighing on values. Dallas, Fort Worth is mixed. Some suburbs down 4%, others slightly up thanks to relocations. San Antonio's affordability edge is dulled by taxes and insurance, pushing prices down 3.5%. Houston stays steadier with energy jobs, but insurance pressure bites. Smaller cities, Waco, Tyler, College Station, are bucking the trend with modest growth, boosted by remote workers and retirees. Texas isn't collapsing, it's redistributing. Demand is shifting away from overheated cores toward balanced, mid-size markets. The frenzy is gone, patience and negotiation rule. By late 2025, the base case, flat to slightly lower prices, with potential rebound by mid-2026 if rates ease. Fundamentals, jobs, population, pro-business policies, remain intact. The current scoreboard, median around $331,000. Inventory, up 30.7%, homes, selling in 105 days, sales down 1.5%. So what do? If you're a buyer, get fully underwritten, watch rate dips, and target motivated sellers. Focus on monthly payment, not list price. Leverage concessions, rate buydowns can beat price cuts over time. If you're an investor, be selective. Look for forced seller situations, builder closeouts, and markets with durable employment bases. Underwrite with conservative rent growth, and higher capex, and insurance assumptions. If you're a homeowner, know your comps, not just your estimate. If you must sell, price to the market early, and use incentives strategically. If you don't have to move, the rate lock mode is real, stability favors staying put. The warning signals are clear. The data is aligning with past pre-crisis patterns, with one critical difference: prices have detached from incomes even more than in 2006. This is what a slow-motion reset looks like: uneven, regional, and increasingly psychological. How severe will it get? That depends on rates, jobs, and credit conditions. But the early map is already being drawn, neighborhood by neighborhood. What are you seeing where you live? Drop your observations in the comments. The real story is unfolding on your street. Music swells, then fades out.